If you only look at US headlines, today's market moves can feel random. Stocks dip for no reason, crypto suddenly gets shaky, and bond yields jump when you thought the big story was something else. But there's a hidden lever that can yank risk assets lower fast, and it starts in Japan. Not because Japan is crashing, but because the Japanese yen is tied to one of the biggest funding trades on Earth. And when that trade starts unwinding, it can hit US stocks like a wave, quickly and sometimes without warning. Before we get into the chain reaction, if you want more simple, story-style breakdowns like this, no jargon, just the real mechanics, take a second to subscribe. I post updates that focus on what matters for a US audience, what can move your portfolio, your retirement account, and your everyday financial life. It helps a lot, and it keeps you ahead of the crowd. Now, here's the core idea you need to understand. For years, Japan has been the world's cheapest place to borrow money. Ultra-low interest rates made the yen a funding currency. Big traders could borrow yen at very low cost, convert it into dollars, and buy higher return assets, U.S. stocks, corporate credit, long-term treasuries, and sometimes even riskier trades. That strategy is called the yen carry trade, and it works great until the yen stops cooperating. Because the carry trade has one big weakness. It depends on the yen staying weak, or at least stable. If the yen strengthens sharply, the math flips. The debt you borrowed becomes more expensive in your home currency terms, hedges get pricier, and risk managers start demanding you cut exposure. That's when the exit begins. And the exit is where the danger is, because it's not one trader leaving quietly. It's potentially a crowded group trying to squeeze through the same door. Let me make it feel real with a simple story. Picture a large fund in New York. They've been under pressure for years to find yield. Safe returns haven't been enough. So they borrow in yen because it's cheap. They convert to dollars. They buy US assets that look strong. Big tech, high growth names, maybe some corporate bonds, maybe some leveraged positions because volatility has been calm. Month after month, it works. The funding cost is low, the yen isn't rising much, and the US market keeps rewarding risk-taking. Then one week, Japan shifts. It might be a Bank of Japan policy hint. It might be Japanese bond yields rising. It might be the market suddenly believing Japan can't stay ultra-loose forever. The yen strengthens. At first, it looks like a small move, but the fund's risk team sees it differently. They see a funding cost rising and a currency move that can eat profits fast. And they start asking a question that changes everything. What happens if this keeps going? That's when the unwind begins. Not necessarily as panic. At first, it's de-risking, trim positions, reduce leverage, tighten hedges. But here's the catch. When many players run similar strategies, de-risking becomes selling pressure across the same areas. That's why US stocks can drop fast, even when nothing major happened in US news. The problem isn't the headline, the problem is the plumbing. Now, when people say Japan is unwinding the carry trade, it can sound like one official decision, like Japan pressed a button. In reality, it's usually the market doing the unwinding. Expectations change, currency moves, and traders react. And reactions can turn into feedback loops. Here's how the feedback loop works in plain English. The yen strengthens. That makes carry trades less profitable and more risky. Traders reduce positions, which can mean selling US risk assets. Selling pushes markets down. Volatility rises. Higher volatility forces systematic funds to reduce exposure automatically. That adds more selling. More selling pushes volatility higher. And suddenly, you're not looking at a normal pullback. You're looking at a liquidity event. This is why I'm using the phrase US stocks could drop fast. Not because a crash is guaranteed, but because the mechanism can move quickly once it gets going. It's like pulling a thread in a sweater. At first it's nothing. Then you realize the thread was holding more than you thought. Now let's talk about why Japan matters so much in global markets. Japan isn't just another country with a central bank. Japan has one of the largest bond markets in the world. And it's been the anchor for ultra-low rates for a long time. If that anchor starts lifting, if Japanese yields rise and the yen strengthens, global capital has to reassess. Some investors may decide they can earn more at home without taking currency risk. Others may have to pay more to hedge. And the whole world that got comfortable with cheap funding forever gets uncomfortable. For a US audience, this connects directly to two things: liquidity and valuation. US stocks have benefited from global capital and easy financial conditions. If global liquidity tightens because funding trades are less attractive, US valuations can come under pressure, and that pressure can show up quickly in the places that were most crowded. Big tech, high beta sectors, speculative growth, and anything that needs easy money psychology to stay elevated. And yes, crypto often trades like a high beta liquidity asset during these moments. When funding stress hits, investors don't always sell what they hate. They sell what they can. They sell liquid positions. That's why you can see crypto drop alongside stocks when liquidity tightens. It's not always about crypto news. It's about the funding environment. Now, I want to keep you watching past the first few minutes with something most people didn't realize. The yen carry trade isn't only about buying stocks. It can also be tied to bonds, especially when global investors have been hunting yield and duration. If Japanese yields rise and Japanese investors shift behavior, global bond yields can move too. And if US yields rise, that can tighten financial conditions inside the US economy. Mortgage rates, corporate borrowing, consumer credit, everything starts feeling a little heavier. So one move can hit multiple corners at once. Stocks, bonds, and crypto. That's why it matters. Now, let me address a common question. Is this just Japan selling US assets? Sometimes Japanese institutions do adjust holdings, but the bigger story is broader. It's not just one country's decision. It's the global cost of money changing. It's the funding currency moving. It's the unwind of leverage that was built on stability. And leverage is always the thing that makes moves feel sudden. Here's why. A normal investor can hold through a pullback. A leveraged trader can't. A leveraged trader has to meet margin requirements. They have to cut risk when volatility spikes. They have to respond when their funding cost rises. That's why the unwind can accelerate even if the underlying economy hasn't changed overnight. Now, let ES talk about what to watch if you want to understand whether this is a one-day scare or a real unwind. The first thing is USD JPY, the dollar versus the yen. You don't need to be a currency trader. Just watch direction and speed. If the yen strengthens steadily over multiple sessions, that's more pressure on carry trades. If it's a one-day spike and it reverses, pressure can ease. The second thing is volatility. The market's fear gauge, often the VIX, matters because many strategies scale exposure based on volatility. Rising volatility can mechanically force selling. Even if you don't trade those strategies, they trade you. They influence the market you're in. So if volatility is rising while the yen is strengthening, that combination is where the unwind story gets more serious. The third thing is US yields, especially longer-term yields. If US yields rise sharply, it can pressure stock valuations, especially growth. It can also tighten conditions for housing and credit. The yen carry trade and Japan's bond market can spill into these moves through global flows and hedging costs. The fourth thing is credit spreads. Credit is the quiet heartbeat of markets. Stocks can be emotional. Credit is often more disciplined. If credit spreads start widening while stocks are falling, it can signal stress moving beyond traders and into financing conditions. Now I want to connect this to something you've probably experienced. Have you ever seen a day where the market sells off and then people scramble for a reason? They pick one headline and say, that's why. But markets don't always move on one reason. Sometimes they move because a hidden trade is being repriced. That's exactly why the yen carry trade matters. It can be a hidden driver that explains why multiple assets move together. Now, let's keep it very practical for the US viewer watching this at home. If you have a 401k, if you own index funds, if you own tech-heavy exposure, you might be more connected to liquidity conditions than you think. When liquidity is abundant, dips get bought quickly. When liquidity is tight, dips can keep dipping. Here's the question that decides whether a sell-off becomes fast, who is forced to sell, and who is willing to buy. In a calm environment, buyers show up fast. In a funding stress environment, buyers hesitate because they don't know where the bottom is, and because their own funding costs might be changing too. That hesitation creates air pockets, those sudden drops that feel like the floor disappeared. Now, if you're thinking, okay, but what exactly is Japan doing? Here's the honest answer. Most of the time, it's not one clean action. It's a shift in expectations about the Bank of Japan and Japanese rates. It can be triggered by inflation pressures, rising wage dynamics, changes in yield curve control, or the market simply deciding that Japan can't hold rates down forever without consequences. Even small hints can matter because the carry trade is built on small differences. When you're leveraging a small difference, small changes become big problems. This is also why these moves can cluster around certain weeks. You get key economic data, you get central bank meetings, you get bond auctions. You get moments when traders have to rebalance. If positioning is crowded, these moments can spark sharp adjustments. Now, I want to keep your curiosity going because there's one more layer that's easy to miss. A lot of investors assume that if the yen strengthens, the dollar must weaken, and that should be good for certain assets. Sometimes that's true. But in stress events, relationships can flip temporarily. People rush into cash. Sometimes the dollar strengthens because global funding still runs through dollars. Sometimes treasuries rally as a safe haven. Sometimes yields spike because of supply fears. It can get messy. That messiness is another sign of an unwind. Correlations become unstable. So what are the realistic next paths from here? There are three, and watching which one we're entering can keep you calm instead of reactive. Path one is the fade. The yen move cools off, volatility eases, and risk assets stabilize. This happens if the market got overpositioned and then corrects without more fuel. Path two is the grind. The yen stays firm, volatility stays elevated, and stocks chop lower or stay unstable for weeks. This is common because big portfolios don't always exit in one day. They reduce over time. Path 3 is the snap. The yen strengthens quickly, volatility spikes, and selling becomes forced. This is the path where you see drop-fast days. It usually happens when key technical levels break and systematic funds de-risk together. You don't need to predict which path. You just watch the signals. Yen persistence, volatility persistence, and whether dips are being bought or sold quickly. Now, I'm going to give you a simple tomorrow watch checklist you can use in under a minute, and it's specifically designed for a US audience. Check USD JPY. Is the yen still strengthening, or did it reverse? Check volatility. Is it rising, stable, or falling? Check the market leaders. Are mega-cap tech names holding up or rolling over together? When leaders fail together, it's often liquidity, not a company story. Check US yields. Are they moving sharply? Higher yields can add pressure to stocks. And watch the bounce. In healthy markets, bounces hold. In stressed markets, bounces get sold quickly. If you see yen strength plus rising volatility plus weak bounces, that S when carry trade unwind stops being a theory and starts being a live risk. Now, I want to say something that will help you psychologically. The goal is not to panic. The goal is to understand why markets can move fast without obvious headlines. Once you understand the plumbing, you don't feel blindsided. You make better decisions because you're not reacting to noise. And this is why Japan matters right now. It's not because Japan controls the world. It is because Japan has been one of the quiet foundations of cheap global funding for a long time. If that foundation shifts, the world has to adjust. Before I wrap up, I want you to think about one last question, because it's the question that tells you whether this stays contained or grows. If the yen keeps strengthening and carry trades keep unwinding, who steps in as the steady buyer of risk assets? If the answer is everyone is cautious, then drops can be faster. If the answer is buyers still have confidence, then the market can absorb it. Now I want to hear from you. In the comments, tell me what you're watching most closely. USD JPY, the S&P 500, the NASDAQ, crypto, or US bond yields. And what's your biggest question about the carry trade? If you want, I can do a follow-up that explains the carry trade with a simple step-by-step example and the exact signals that usually show up before the unwind accelerates. If this video helped you, please share it with one friend who keeps asking why markets feel shaky for no reason. This is often the reason, and sharing helps more people understand what's happening before the headlines get dramatic. Educational only, not financial advice. The main takeaway is simple. When the yen strengthens and the carry trade unwinds, it can pull liquidity out of US risk assets faster than most people expect. Watch the currency, watch volatility, and don't wait for the news to explain what the market is already doing.